Hello, hello. I'm going to go ahead and wait about a minute or two to start for people to show up. I'm also going to turn this on TikTok for the first time in forever. I'm going to have 3 views on the Tiki-Taki. That's all right. All 3 people. Hopefully they're entertained. So we're going to wait about 2 minutes for people to show up, and then we're going to start. It's going to be pretty prompt. This webinar should last probably 30, 40 minutes. This is probably the 10th or 15th webinar I've run in the last 6 months. And the way these webinars tend to work are we make them up on the fly. I have a general idea of what I want to talk through, but you guys are going to build this with me. I've run them both ways where I've built out some slides before and talked through some things. And to be quite honest with you, most people think it's boring. I'm a data guy, so I don't really give a shit. But I think it's a little bit more fun, a little bit more hands-on when we build this stuff out together. And so that's what we're going to do. What we're going to be focused on tonight, we're first going to define what a stage 1 base is. Most of you guys probably know. And then we're going to talk about what a stage 2 breakout is, why both of those matter, the difference between 2023 and 2024, because there's a big difference. You cannot trade the same way this year as you were last year. It requires different strategies. We look at 3 different ways to trade these uptrends. We're going to go through all 3. 2 of them we've hit over the last 2 months. So we're going to go through specific trades that we're currently in TTI. So there's going to be real examples here. We'll show you the real profits, the real entries, stops, etc. So you guys are going to get a full-on experience here. All right, without further ado, let's get into it. This is not the whole strategy, not at all. This is just one very small portion, but hopefully you guys take something away from this. So let's go ahead and start really quick. Like I said, we're going to build this out here. So the Wyckoff Market Model, Weinstein Stage Cycle, that's all essentially the same thing. What are we trying to do? We're trying to categorize the market oscillations, right? So as everybody knows, it doesn't matter what type of trend it is, but we're going to focus on an uptrend. Uptrends look like this. Unless it's SMCI and it goes straight up, right? Unless it's SMCI, generally you have some sort of staircase. That would be your patented uptrend. At some point at the top, we start to top out. This would be a distribution phase or a stage 3. That generally comes before a downtrend, a markdown, a stage 4. Then you have the stage 1, which is at the bottom of an oscillation, accumulation, and then you expect the next markup. So when you think about all of this together, generally you have your stage 1 into a stage 2, into a stage 3, into a stage 4, and then hopefully the next stage 1 is a little bit higher. And this is how you get year-over-year uptrends like you see in things like SPY, for example. You come out on the monthly. Doesn't matter which asset you're looking at. This is just a market model. It goes across all assets. Anything with the chart you can see, as long as the stage 1 bases on a long time frame are higher than the previous stage 1 bases, you're going to get uptrends over time. Right? That's how trends work. Fun stuff. Let's go back. So last year was the year of stage 1 bases. What does that mean? Well, we were coming out of a prolonged bear market. Don't let anybody tell you otherwise. From 2021, end of 2021 to the end of 2022, we had one of the longer bear markets in history. It's not the longest, but it was one of the longest. Generally, bear markets don't last a year, which essentially it did last year, or 2 years ago at this point, 2022. So for those of you that are expecting new lows, statistically, you're batting probably a pretty low winning percentage so far, because not only are we at all-time highs, but I think it's very clear to everybody with a couple brain cells that we are in a bull market, or in year 2 of a bull market. So last year, as we were coming out of this bear market, or 2 years ago rather, we hit these stage 1 accumulation zones. And that's what we were trading last year. If you've been following any of our content, all of the things that we were entering Q1, Q2, and Q3 of last year were breaking out of these horizontal levels, something like this. And we can come up with a few examples, actually. A lot of these mid-cap, I think some of the Potter's guys are in a trade called Frog, F-R-O-G. Great example of a stage 1 into a stage 2 uptrend. So here's your IPO into a markdown phase. That would be what? A stage 4 downtrend into a stage 1 accumulation base, into your markup period or your stage 2 breakout. Very simple. Every market trades like this, right? That's what the idea here of being able to define these different stages of the market. So stage 1 was all about buying stage 1 base breakouts. So I'm going to go ahead and delete these. I'm going to go ahead and type that. Build this out here. Stage 1 are horizontal base breakouts. Generally, the longer the base, the bigger the breakout. Can we all agree on that? Technical Analysis 101. The longer something consolidates underneath overhead supply, eventually it's going to break out. Generally, the longer it consolidates underneath, the stronger the breakout, the stronger the primary trend, right? We can all agree on that. That's TA 101. So stage 2, if stage 1 is a horizontal level breakout, stage 2 is what? What's the uptrend? That's it. Let me ask you something from just a pure TA standpoint. Is it easier to trade something that is building out a base or consolidating underneath the horizontal level, and then you see the breakout? Now, how you actually attack that breakout, I don't want to get into it. We do it a certain way. You probably do it a certain way. But we can all agree that that point right there is pretty important. But it's very easy to understand when we're breaking out. Why? Because horizontal levels, regardless if they're zones or specific price points, are very easy to draw on a chart. Not too many people are too far off because they're very obvious. The hard part is when something throws back and then starts to uptrend. How do you get involved if first you missed the stage 1 into a stage 2? But second, what happens if you run out of expiration? You're an options trader and you want to get back in. You just indiscriminately buy? This is a completely different playbook than this, even though both of them are profitable. So what we're going to look at today over the next 30 minutes are 3 different ways we trade uptrends, these stage 2 uptrends. Like I said, it's a completely different playbook. If you're waiting for horizontal levels to get broken out that have been basing over the last 2 years, I'll be honest with you. If your focus is to trade the strongest stocks, is it fair to assume that a majority of the strongest stocks in the market have already broken out? Yeah, absolutely. As a matter of fact, most of them are already at all-time highs. So the uptrends are where we're focused on in 2024. 2023 were the horizontal level base breakouts. We can all agree on that, right? The 3 different ways that we, inside of TTI, trade these uptrends, we're going to focus on consolidation, fractals, or let's do continuation fractals. Continuation fractals. So before we get into that, think about what that might be. What is a continuation fractal? Consolidation, bases, dynamic support. Now there's others, but just like anything in the world, if you focus on learning everything under the sun, you're going to become a master of none. So focus on 1, 2, 3, whatever. Get really good at just that specific thing before moving on and opening up your world to everything else. Because I promise you, there is so much shit in the market that it's overwhelming to focus on all of it. So dive into one specific thing and get used to it. Let's start with continuation fractals. What the hell is a continuation fractal? What is fractal? Fractal is a term inside of technical analysis that means a period. Let me go ahead and type it out. I think that's going to be too ridiculous if I use the paintbrush. Period of price action that is repeatable. What does that mean? Chart patterns, right? Chart patterns is a period of price action that is repeatable. It repeats across all different time frames, and it's entirely induced based off of demand and supply, price behavior, trading, right? Fractals are repeatable across all different time frames, and therefore, swing traders, specifically inside of TTI, we're looking 45 to 180 days out. We can trade the exact same chart patterns that you guys are trading intraday as day traders or scalpers. Do not mean pivots in this case. So period of price action that is repeatable. Continuation fractals. What types of continuation fractals can you reasonably assume are going to happen in uptrends? We're going to look at a few in a second, but one of the more popular ones is something like a high and tight, which is a big move to the upside, followed by some sort of horizontal consolidation. And what's the key mark or the hallmark part of a high and tight? Most people would consider a high and tight a bull flag, but they're two distinctly different things based off of the stats around the actual play. Bull flags are great, don't get me wrong. But a high and tight is specifically a tight consolidation phase with very little white space behind it. And that is important. Here's an example. This is a trade. Well, here, I wanted to focus on pictures first. I got to show you that this shit works, right? You can sit here and watch me say all this stuff. Doesn't really matter unless you're like, all right, these guys are actually trading this and it works. ARM, 2,050% profit there, 2,000% profit on this guy. Anyway, you get the drift. We've been long ARM for a long time. For those of you that follow the content, you're probably long ARM with us, so congrats. High and tight. Can you find it here on the chart? You're looking for a parabolic move over the course of 1 to 5 trading sessions, followed by a tight consolidation range that generally channels horizontally. It's pretty easy once I kind of spell it out. It's a high and tight. What makes this a high and tight, not a bull flag? Because there's very little white space in here. It's consolidating. The tighter the fractal, generally, the better performer it is. Just so you guys know that. There are two different types of chart patterns, just so everybody knows. This isn't really what we're talking about, but you have loose patterns that look something like this. There's a lot of white space. Generally, those do not perform as well as the names that really are very tight within the trend lines that you're utilizing. So keep that in the back of your mind when you look at chart patterns, loose versus tight. Tight patterns tend to play out better in the long run. Get your mind out of the gutter. High and tights. Continuation fractals. What would you do here? There's two different entry points. Now, the trade itself had already broken out of a base. We bought this. How do you get involved in a trade that's already up? And by the way, this doesn't look like it's up that much because it's up so much right now, but we got in off of the 56.5-ish pivot. And by this point, we're already up like 12 to 13%. And the options contracts were up like 150 or whatever. So we were trimming into profit there. You guys know how this works. We trimmed half at 100% to turn it free. But then we realized, hey, we're probably in something where we should be looking to add into this trade actually and probably go further out in expiration. So how would you trade a high and tight, a continuation fractal? There's really only two different ways to do this logically. You wait for the breakout, and if you're in TTI on high volume, which this did have, you wait for the pullback. If you're not in TTI, you don't know what I'm talking about, just look for a breakout. You play the top of the range. A continuation breakout is essentially what it is. That's the easiest way to do it. I'm not saying it's the most profitable, but it's the easiest. The most easy. It's the easiest. It's the other way to do it. Buy the bottom of the range. Buy the bottom of the range. It's not always going to work. Some of these are going to break back down below, but what's the benefit of buying at the bottom of the range? You know exactly where you're wrong. A close below bottom of the range, you're out. So let me show you something really quick. Oh my Lord. Use a long tool here just to have a general idea. I don't know where our price target was, so I'm just spitballing ideas out here. So it's the overall idea that I'm trying to prove here. Let's say we buy the bottom of the range and our stop is below range low, which is around, we'll say $60. I'm pretty sure that's actually what we used. Look at the risk to reward on something like this. 11.5 to 1, meaning for every dollar from a shares perspective, every dollar you're risking, you're looking to make 11.5. That's a break-even win rate of like 5%, by the way, versus something like a breakout entry. Where would you put your stop? Would it be in the middle of the range? Most people would say bottom of the range. Technical Analysis 101 says put the stop at the bottom of the range. Makes sense. But all of a sudden, 11.5 to 1 turns to a 2.3 to 1. Understand the difference between the two? It's the same trade idea. You're utilizing the fractal as an entry point and a stop. But by buying at the bottom and having the same stop as the dumb shit that bought at the top, you're skewing the risk to reward by a lot. It's a completely different trade. If your entry is somewhere here and your stop is at the bottom of the range as opposed to the top, right? So that's just to throw that out there. There's two different ways to play this. One of them in TTI's mind is more beneficial than the other. But remember, there's different ways to play these types of continuation fractals. And I used one stop loss. Who knows? If you're buying the breakout, maybe you place your stop right underneath the pivot point. That's totally understandable as well. But the thought process here is there's two different entry points on this particular continuation fractal, bottom of the range or the breakout. Your stop loss is completely up to you, but the goal is the same. It's a continuation break. So that's one example of a continuation fractal. Where was I typing? Here we are. Another example of a continuation fractal is Spotify. So once again, let me prove to you that we're in Spotify. These are not just bullshit charts I'm pulling out of my ass. Spotify, 229%. We have a couple other guys in it as well. But you see, we have skin in the game, right? I'm not just pulling this out of my ass to talk about Spotify. Continuation fractal. Pretty easy to see. Rounded bottom into a horizontal level break. Call it a cup and handle, whatever you want to call it. It doesn't matter. It's a continuation fractal on a break above previous overhead resistance, right? Now, this had an added feature. Think about what the price point was at that overhead resistance area. $200. We all know, regardless of whether or not you believe it, the big round numbers tend to be sticky. Go through your chartered market technician courses, get to level 3, and they tell you the reason why big round numbers matter are because humans are stupid. That's it. We're just drawn to big round numbers. They have no reason why $200 should be sticky, but it is. There's no reason why $100 should be sticky, but it is. We gravitate towards them, and we tend to hover around them. And we can actually confirm that. VRVP shows us over here that there is an incredible amount of volume beneath $200, and then you get the huge breakout. I mean, that makes sense. Consolidate underneath $200, you get the breakout, all this pent-up demand down here. All of a sudden, price shoots up and through. So once again, it's a consolidation, or not a consolidation, it's a continuation, right? This stock originally broke out back here. I'm not saying it was a super easy trade, but once it's very firmly in an uptrend, you can't just randomly be buying it, because what are the risks here with randomly buying a stock that's in an uptrend? Everybody's been there. You buy it today. Let's say Spotify pulls back. You think you bought the top and you're out, when in reality it's just a pullback in a strong uptrend. So you need to have a place to risk. Finding these types of things gives you an opportunity to establish your risk level and therefore know when the trade idea is invalidated. Last one we're going to go through is Uber. Well, we'll use Uber for the next example, actually. So there's two different examples of a continuation fractal. So the first one was a high and tight. The second one was a rounded bottom breakout or a cup and handle, whichever you want to look at. The second one, we're going to go through consolidation basis. So let's go through Uber first. So Uber is a trade that we've killed all year, for going back a year, right? For those of you that have been following our content for a while, we bought 37.5. We re-added again at 47 or 48, and we just re-added again at 64. So this is one of the best performing trades we've had as a group over the last 12 months. And once again, just to prove to you that we're in it, Uber 332%, 343, etc. So we've been in Uber for a while. Most people would look at Uber at 64 and go, I don't want anything to do with it. It's pushing up into all-time highs, which is a common fallacy. Totally get it. They would have preferred to buy it at 35, 36, 37, but nobody ever does, right? There's a reason why there's edge buying it there, because nobody wants to buy it. But the fallacy of buying something that's already too high, expecting it to come back down in a bull market, is exactly why these things don't break back down. A lot of people short these things into all-time highs, and then they get squeezed. Happens all of the time. Now, Uber had a little bit of help here, included into the S&P 500, and then whatever just happened with Lyft that caused this thing to gap up 2 days ago and continue. Thank you, Lyft. But we got in off of consolidation underneath overhead supply at all-time high. Literally, that's it. We'd traded Uber twice. We said we're pressing up into the 64 area. We don't want to own it until it flips 64. Look how long this thing took to break out. It was hovering at 62, got caught in a market pullback, didn't actually break for 36 days. We waited. We waited. We waited. Imagine, most people can't wait 5 fucking minutes without their phone before becoming socially anxious and needing to leave the room. We waited 36 days to own this fucking stock. You can see, and it was worth it. Obviously, you see what the profits are. But these consolidation fractals or patterns underneath specific price points are an incredible tool for you to use in uptrends. Because once again, the key here is that you know exactly where you're wrong. Where are you wrong once this thing breaks out? 64. It's straight up. It's simple. Kind of like the stage 1 bases, these consolidation fractals give us the opportunity to know a specific price point or level that where we're wrong. The continuation fractals, if you will, have a little bit of leeway, right? Chart patterns are not as high performing, if you will, as horizontal levels. And that's just by nature. Horizontal levels are generally a specific price or a zone, and every asshole knows how to draw a straight line, whereas every other TA trader might have different trend lines on chart patterns, and that does, through the power of self-fulfilling prophecy, dictate a little bit of the performance on the actual chart breakouts. So Uber was a good example of a consolidation. How about Meta? Can you find a spot on the Meta chart? I'm sure you guys have seen the trade, but I'm going to show you again. We're long Meta. We've been long Meta. You just saw 1,100%. But Meta was Dustin's first $100,000 win. So I'm going to show you exactly where he got in and why. But there it is, $105,000 win, and this was back at the beginning of February. He still owns half of the position, and Meta was at all-time highs today, so he's still up. It's probably going to be $120,000 or $130,000 win by the time he's done. He does have marches, so if you're listening to this, Dustin, get ready to start selling. But let's get into this. Let's start talking about this. Where's the consolidation fractal on here? First off, we took 3 entries on Meta last year. I'll be the first to tell you we did not buy this. This was an incredibly hard buy, but kudos to anybody that did. This was at the bottom of the bear market of 2022 and then the pivot. So just to show you guys something, for people that are afraid to buy uptrends or names that have already broken out, from the bottom to where Meta broke above the 200-day moving average, it was already up 75%. So once again, if you have some weird fetish about not wanting to buy uptrends, you're going to miss an incredible opportunity in strong stocks. You don't have to buy the absolute bottom. You just have to participate 80% of the time. So we waited. And we waited. We were buying other things instead of Meta back in Q1 of 2023. We bought NVIDIA. Unfortunately, not enough time. We made good money on NVIDIA, but definitely not enough. We bought it here after the gap up. This was the first buy we had on Meta. What is this, right? It's a continuation pattern. Which continuation pattern is it? What type of chart pattern is this? Pretty easy. You have a rounded bottom and a bull flag on the right. It's a cup and handle. Anybody 5 years old or more can spot a pattern on a chart. I make fun of people all the time on this because they sell services that just, hey, look, there's a symmetrical triangle, go along. Everybody in the fucking world can find this stuff once you know what to look for. It's not hard. The hard part is once you're in it, do you know what the fuck you're doing? And that's where most people fall off the face of the earth. So this is a good example of a continuation fractal. We bought it. This was our first price target. We got a lucky gap through ER. What is this called, everybody? PEG, a PEG, a power earnings gap. We rebought here, or actually we bought on the pullback. We never buy on up days. We were lucky enough to have our next price target at 315, right where the fib is. Took profits, and then we waited. Now let me set the stage really quick on the meta trade. And as a matter of fact, you saw the overall win on it, but let me show you something really quick. Because I think this might give me just a little bit of validity here. This is our market research portal. This is where we post all of our trades, all of our ideas, everything like that. This was the meta chart. The third time we wanted to open it. You can see, right? You can see where our original entry was. You can see that that's where our price target was, etc. So this was back in November 2nd, I posted this. This was right at where the market bottomed. The market bottomed October 27th, I believe, in 2023 after the 3-month consolidation. Or not consolidation. It was not consolidation. It was a corrective phase. The indexes came down 10%, excuse me. What did Meta do, though? Which is why I'm showing you this. Meta did not participate in the 10% correction to the downside. Instead, Meta went sideways. What happens when an individual stock or asset goes sideways and the benchmark goes down? What is that called? It's a 2-word phrase. It's one of the pillars of TTI. It's called relative strength, baby. That means that when or if the benchmark flips to the upside, this should be one of the stocks that you should be looking to own because for whatever reason, the market didn't want to sell this off at the same rate as everything else. Relative strength. We focused on that. Here was the actual trade idea. We said risk on above 305 with a price target of 380. Has the actual options play that we were looking at, etc. So here we are. Take us back to November. Thought process here was Meta was not going down with the rest of the market. Very obviously, like I said, a 5-year-old can choose a direction. Is it going up, down, or sideways? It's going sideways. Relative strength. But what is this type of pattern in an uptrend? Very obviously an uptrend. By the way, by the time we opened the third trade on Meta from its absolute floor, once again, we opened it up somewhere in the middle, 315. We said 305, but I think we lied. I think we waited till 315. It was up 250%. Can you imagine looking at 250% and going, ah, man, it's Meta, man. There's no way. I'm going to tell you guys something. The best stocks in the world tend to continue to go up because they're the fucking best. Regardless of what you think about Zuckerberg or his products or the fact that nobody uses Facebook except 60-year-olds that retweet conspiracy theories about lizard men and birds being spies and shit. Who gives a shit? We're trading the stock, not the company. So you look at this up 250%. You see a consolidation fractal underneath overhead supply at 320, and you go, huh, I want to own this fucking thing on a breakout. And so we did. Unlike the chart pattern continuations, which are the high and tights, which are the cup and handles, this was just a simple sideways when the market came down, buy the goddamn breakout. Buy high and sell higher. If people say that doesn't work, I have about 74 trades in the last 6 months to prove you wrong. It's just you do that in a bull market. In bull markets, you buy high and sell higher. It works. You don't have to reinvent the wheel. So once again, this is a great example of a continuation fractal, right? So instead of, or excuse me, not a continuation, a consolidation fractal. These are continuation chart patterns. This is just a simple look for things that are moving sideways when the indexes are coming down, overhead supply, buy the breakout. Now, I don't want to sit here and tell you it was a super easy trade. When the index or when Meta pulled back, by the way, the market was roaring and we had a very serious discussion inside of TTI. Should we still be holding Meta? Everything else is going up. At this point, Meta was coming down. You could see here from late November through early December, if you were trading that time frame, small and mid cap stocks were going nuts. And we were like, should we really have this much money parked into a mega cap that is not performing? So we had some serious dialogue and we decided to stay, which ended up being the right decision. So let me ask you guys something really quick. Not telling you to go buy Meta today, but what the fuck is this? And what is that? This is something called a breakaway gap. And what is this? That is a fucking consolidation fractal that you buy the breakout of again, which is why Dustin did not close his entire position. Now, does he want to own this again? I don't know. Market's kind of frothy. We're prepping for a pullback in the market. We expect it's going to happen. So we're not opening up a bunch of new positions. But if you're already in a position and you're sitting there thinking to yourself, should I close this whole thing after 2 or 3 days post ER? You're thinking to yourself, is the gap going to fill? It doesn't fill. I'll tell you something. There is nothing more bullish in a stock than a gap that does not fucking fill. Leave a contract on there. Hit the grand slam. Let's go into another one. This is a trade we just opened up. Look how beautiful it is when I put time into this stuff. Netflix. This is not a trade that I took, but we are in it as of 2 days ago. So we caught the last 2 days worth of the move. Once again, a good example of a stock that bottomed middle of 2022, by the way. Netflix bottomed before the broader market. Who gives a shit what you think about Netflix? This thing is up from peak to, or from trough to peak now, 257%. We were not interested whatsoever in Netflix other than a brief period here, which I think people traded, but it wasn't me. What we've been focused on instead is how do we get a piece of it now? And so we built the story. Here's your EP breakout, EP meaning episodal pivot. What does that mean? High volume and a thematic change in the stock. For whatever reason, from ER to ER, Meta came down nearly 30%. Remember, this is the time in the market and the indexes in particular where they pulled back 10%, right? It was a corrective phase and Netflix corrected 30%. So let's go back to Meta really quick. Well, Netflix corrected 30%. Meta did nothing. There's another reason why we wanted to own Meta. And by the way, Netflix is a communications name. Meta is a communications name. So if you're into sector strength, maybe you don't want to own both Netflix and Meta. So you had a decision to make. Do you want to own Meta or Netflix if you want one big mega cap per sector? Answer is very, very obviously Meta now. But even then, you can look at it. I'll prove it to you. Netflix against Meta. This is a ratio chart between the two individual stocks. You're taking the absolute performance of Netflix and dividing it by the absolute performance of Meta. If Netflix was outperforming Meta, this should be going up. As a matter of fact, let's do that. Watch how high it goes. Meta is the stronger stock, so that was the right call. There's a little fun fact for you guys. Hopefully you take that and bake it in somewhere, but that's a different topic for a different conversation. So here we go. EP, thematic change on high volume. We're looking at it. We didn't trade it. Then all of a sudden we get a breakaway gap. Once again, doesn't matter what we think about Netflix. There's a lot of people inside of TTI that hate Disney and Netflix. I've completely shielded myself away from any of the bullshit, so I have no idea. But the chart's screaming buy it. What's the difference between this? It's the same concept that we just did with Meta. Sideways consolidation, buy the continuation play. In this instance, it was a descending trend line instead of a horizontal level. It's not that hard. Know exactly where you're wrong. And once again, we were talking about that with the ARM trade. What's the good part about buying these tight consolidations? You want to pretend that this is a bull flag, feel free. It's not, but you can say so. But let's pretend it is. Is there a whole lot of white space in there? No. So once again, the tighter the consolidation, generally the bigger the performer they are. What's the beauty of buying this specific breakout above the descending trend line? Your stop loss is bottom of the range, essentially the previous day's low. Our take profit is 640 to begin with. This is a 5-to-1 setup. If we're wrong, that's fine. Close out and move on. But a 5-to-1. Our first PT is 640. Our second PT is 680. Now we're not going to hold the full position up here, but that's a 7.5. And then 700 plus is all-time highs, which is totally within reason given how the market's moving this year. But now we have an incredible opportunity in Netflix inside of TTI because we are ahead. Even if Netflix pulls back, let's say the market dumps tomorrow or Tuesday or whatever, we're already ahead in the Netflix trade where we have a little bit of wiggle room to let this thing go. Even if it pulls back to entry, we're not going to get stopped out. So it's another example of a consolidation fractal instead of the continuation. So once again, it's two different things. Let's go back to app really quick and look at it. Here's another example, by the way. We're not going to go through all of it, but remember, continuation fractals, consolidation bases. This is a consolidation base as well. Consolidated here for 4 months. Not going to lie to you, it was not an easy trade, but we took it and we got paid out today, literally today. Once again, since we're talking about it, I don't know if anybody actually posted it. There we go. 197 for Steve. Steve's from Simple Stacks. What's up, Steve? I don't know if anybody else posted app. I'm up 300 something percent in it, so I'm okay with that. I'm cool with that. App's cool with me. But once again, it's a consolidation basis. So the last one that I want to talk through is not something that we've used yet, but it's dynamic support. What does that mean? Dynamic support. Dynamic support, dynamic in general, means anything that changes via the candlestick. So if you're drawing a horizontal level, for example, each candlestick that gets formed underneath the horizontal level is not going to change the horizontal level regardless of what the candlesticks do. Can we agree on that? And unless you're, well, I won't go there. Unless you don't know what you're doing. Trend lines, ascending and descending. Let's say you have a bull flag. If something breaks like this, you're not going to like look over your shoulder and go, right? We don't do that rookie shit. So dynamic is going to change based off of the candlesticks. So think about what does that actually mean? What could you use as potential support that is dynamic? VWAPs, moving averages, etc. So we don't use VWAPs inside of TTI, at least not as a community. A couple guys do. But we do use some moving averages, mainly the 200-day. What I'm going to use is something, I don't know, something simple like a 10 or a 21. I don't use this stuff, but I know how to teach it. Let's go to the SPY really quick. The SPY. I'm a boomer. Let's go to the SPY. Let's say, for whatever reason, I'm arbitrarily choosing something. You're using the 21 EMA on the daily to figure out whether or not you should still be looking to be long, short, or added to a trend. 21 EMA in this case is the red moving average. Every time, you can see obviously that each candlestick that's printed on the daily is going to dynamically change the moving average. Every time in strong uptrends, something pulls back in towards a moving average, gives you an opportunity to continue to average in if you already have a position. If you're already fully positioned, you would not be doing that. Just to be quite honest with you, you don't over position and stuff like this. I know you can get carried away. You love the trade so much that you're going to buy every pullback. Don't do that. Set a very strict position sizing requirement and only surpass it on A+ setups, which should not be frequent, by the way, so everyone's fully aware. If you've missed the initial breakout, let's say you missed this breakout, you were looking to get long SPY at all-time highs and you missed it, and there was never an opportunity for a pullback, once again, as soon as the 21 EMA, if that's what you're looking for, gets tapped or is close, you buy. So if you missed the original SPY break at 480, once again, this is just totally an example, not what we did. You'd be looking for a pullback in towards some sort of dynamic support, in this case, the 21 EMA. And whether or not you would have actually bought that, I have no idea. But that's the general premises. Let's look at some of the other ones. Meta is so far extended, it's insane. You can see the dynamic support here, the 50 EMA, acting as dynamic support. Every time we get down there, we start to bounce a little bit. These are opportunities for you to add in or establish a position if this is part of your system. Now, I will tell you that this is more discretionary in nature. What does that mean? What does the word discretionary mean? Discretionary means decision. I don't know if that actually is what it means, but that's what it means to me. And what does that mean to us? Well, from a systematic standpoint, there is no decisions to be made in a system. In a discretionary standpoint, everything is your decision. Everything. Why do I say dynamic support is discretionary in nature? You might like the 21 EMA. The other guy might like the 10 EMA. Some other guy might like a VWAP. Another guy might like an anchored VWAP. And where they anchor the VWAP might be different from the other guy that likes the anchored VWAP. So all of these are going to be different. And all of them have different risk and reward models. All of them can be great within the hands of the right trader. All of them can be fucking useless in the hands of other traders. Entirely depends on a wider range of things, including emotional fortitude, if you will. You got to have fucking balls if you're going to make money trading, girls included. Somebody's a little bit riskier. Maybe they're going to buy on the 50-day pullback. Somebody that's less risky might be buying on the 9-day pullback and getting out below the 21, something like that. It's going to be different for everybody. Like I said, none of them are generally better than the rest. You just got to find something that works for you. But this is discretionary in nature because everybody's going to have a slightly different type of dynamic support that they look at. You don't need to. By the way, we have a trader in our group, very large trader, already up and over 6 figures over I guess this year, over the last 2 years, or not 2 years, 2 months. And he uses dynamic supports to do something like this. He uses them both for stops and for ads. And it's a short-term moving average. I don't want to misspeak here, but I'm pretty sure it's like a 9 or an 11 EMA. So, I mean, he's looking to get in and ride strong trends to the upside and get out as soon as they break. Somebody else might look at that, like myself, and go, fuck that. I need more breathing room. Give me the 50. I will sit in a trade for 6 months as long as it's working. So there's 3 different ways to get long. And let me go ahead and show you something really quick. Where's app? When you're thinking of 2023 and the stage 1 accumulation bases, you are looking for a very specific setup. I can name 50 off the top of my head that we traded last year that are probably still, where's the damn chart? Here we go. Here's Sentinel 1. I'm going to get rid of the dynamic supports because I don't use them. But they are valid. So if you like them, feel free to experiment with it. These stage 1 base breakouts, once again, that were everywhere in 2023, very easy to understand. Horizontal level, look for accumulation via the VRVP, look for the breakout, buy it. We showed Frog. That's something that Garrett and the traders inside of Simple Stacks were watching and trading. Stage 1, horizontal level. It's easy to find it. Buy the breakout. The hard part, once again, is how do you manage expectations once it's already up and away? When it's in a stage 1 accumulation, you're not looking for chart patterns. If there's, I don't know, I don't even know where to find one. Ooh, there's a rectangle. I can draw a square. I'm going to play the square. From a swing trading perspective, that's fucking lunacy. You would simply wait for this to break up and overhead resistance. So chart patterns and consolidation fractals and continuation bases mean nothing inside of an overarching market structure, if you will, which is this stage 1 accumulation base. The only time that you should be looking to play these types of setups are once they've already broken out. That's why the playbook is completely different this year than last year. Because last year had very few opportunities to use any of this stuff. It was all about buying stage 1s into stage 2s and trying to stick with them as long as they worked. Now, the names that are breaking out of stage 1 into stage 2, you got to ask yourself if they're even worth trading because they're shit stocks usually, because all of the good stocks are already breaking out. They're already out. Most of them are at all-time highs. This is where you're going to find the continuation fractals, consolidation bases, and that dynamic support idea. So what I want to do for the next 5 minutes, if you guys have any charts that you think, and I don't just want you to ask me my opinion on charts, God bless Garrett for having the goodwill to do that stuff. I'm not going to do it. If you have any suggestions or ideas of charts that are exhibiting continuation fractals, consolidation bases, etc., 5 minutes, throw them out, and I will look at them. We can chart them together. I am streaming this on TikTok, but I have not seen a single thing you guys have said, so I apologize. Feel free on YouTube as well. Just throw out the ticker, and I will try to pull it up. But once again, if it's not a continuation fractal or whatever, I'm not going to look at it. This, in my eyes, EA hasn't even broken out. This is a jumbled mess. Cart. Yeah, this is a name that we're actually long. We got long, or we're getting long, I should say. This is a stage 1, though, right? Just like Frog. Stage 1, we're looking for the stage 2 breakout. XOM, probably for us, you can see there was a previous trade idea here at all-time highs. We're not buying this. There's nothing here. Remember, we're looking for things already in uptrends. XOM is not in an uptrend. This is at the bottom of a range. As a matter of fact, XOM looks like fucking trash. Anything under the 200-day moving average, generally, if you're going long, it's going to be inherently more risky. There's a reason why these stocks are below the 200-day moving average. There's an old quote from Paul Tudor Jones that says nothing good happens under the 200-day moving average, and we take that to heart. If we're going long, these things are going to be above the 200-day moving average. But conversely, if we're going short, these are going to be below. Don't take disrespect for me saying this, by the way. I'm just brash. And by the way, I'm not always right, but Disney is a name. Yeah, so Disney, good job. I appreciate that. Edson. This is a name that we opened up inside of TTI as well. We got the EP breakout. Base. Buy the breakout. It's the same setup across the board. right? We don't have too many setups inside of TTI because the ones that we have tend to work over time. And so we really focus on finding the stocks that are exhibiting those specific setups as long as they also work with what we're looking for in the macro, which is sector, industry, market cap strength as well. So yeah, good call on Disney. This is definitely a continuation pattern that we expect to continue. What's the scanning for stocks in stage 2 breakouts? Completely different video. I'm not going to talk about it here, but generally I'd be looking at 50-day highs with whatever volume requirements you're looking for and just look for base breaks. We have scans that do that, but I don't want to get into it in this webinar. It's a good question, though. I apologize that I don't have the time to do it. VLTO, name that we already have up. I don't know if anybody inside of TTI has this trade, but this is an IPO range high breakout. This is a completely different setup than what we're talking about. But I'm not sure if you notice, we like these types of breakouts. They tend to do very well for us. So there's a little surprise. We like it. QCOM. I don't know what I drew here. I think we didn't want to own it until above like 147 to 150, and it looks like it. Yeah, I mean, this is more of a horizontal level breakout than anything. It's not bad. This is a semiconductor stock, right? And you can't. It's hard to go wrong with semis right now, but I mean, we can all agree that this is gonna end bad. Kudos to everybody that made money. I'm a huge proponent of trading bubbles. You can make a lot of money trading the front side of bubbles. The only people that bitch about this stuff are fucking losers that missed it or marketers. That's it. Imagine buying SMCI off the 280 break, which I missed because I'm a fucking idiot, even though I had it planned, and then complaining as you made money. Nobody complains when they're making money. Now I'm going to say this is going to end bad. We can all agree on that. The question here is how bad does it go, and does it bring the entire semiconductor industry with it in the short term? That's the question you have to ask, because NVIDIA looks damn near the same. So QCOM, I like it, but I'm worried about entering new semiconductors here. Apple looks like shit. It's probably the only mega cap tech stock that I don't like right now. Testing the 200-day moving average. Inside of TTI, we're looking to buy up and to the right, not down. So, I mean, there's a million things that you could be. Please keep in mind, by the way, our time frame is different than some of you guys. We're looking to buy things sometimes 6 months out. So if you're looking to day trade this stuff, take everything I'm saying with a grain of salt here. But inside of TTI, we're looking at buying up and to the right and over overhead supply. Apple at the 200-day moving average does not interest us. VLTO is a good looking stock, yes. The difference between a power earnings gap and a breakaway gap. It's a good question. Whoops, I just typed PEG. What was the Netflix? Power earnings gap is generally going to be because of earnings, and a breakaway gap is, and generally, I should say this, EPs are inherently different because an EP changes the sentiment of the stock. We call this our COD setup. I don't want to get into why it's different than EP is everywhere, by the way. This has been championed by somebody on Twitter called StockB. He created this term, and it works. He trades it differently than us, though. So I don't like to call our setup an EP. This specific gap, though, in my mind is an EP. What does that mean? Like I said, Netflix had drawn down 30% from earnings to earnings, and then out of nowhere, and by the way, below the 200-day moving average, which is a no-no zone for most bulls, and then out of nowhere, we gapped up double digits and then just continued to rip. So at the time, we would have looked at that and go, well, something is very different with Netflix. It's no longer below the 200-day moving average. And as a matter of fact, after drawing down 30%, it gapped up 17, and this is a mega cap tech stock. That's enough for you to stop in your tracks and go, what the fuck? There's something different about this, especially because this happened on October 17th, and what happened for the next 10 days? The market continued to slide. So for the next 10 days, the market continued to come down, but Netflix resiliently did not. So that would constitute me an episodal pivot, something that grabs your attention and goes, whoa, something is very different about this stock. The market is telling us for whatever reason they liked something about the earnings way. A breakaway gap can be fucking anything. It doesn't have to be earnings. In this case, it is. It could be a headline that comes out randomly. It could be a catalyst. Netflix comes out and, I don't know, they say on a fucking Tuesday that their new show just amassed, 100 million viewers, or I don't know what it is. But anything could potentially lead to a breakaway gap. But for all intents and purposes, the stock was already on a clear trajectory to the upside. And so in this case, it's strength buying strength. Down here was weakness buying strength. Or, strength buying weakness. So there is a difference between the two. That was a really good question. Do news like lawsuits? No, not at all. I typically don't know what's going on The only way I know what's going on with the stock is if I accidentally read it on Twitter, because I don't give a shit. And I mean that respectfully. I don't care. There are certain stocks I don't trade because I have bad relationships with them. Snapchat's one of them. I don't trade Tesla, but it's just because I tend to fucking lose on them. It has nothing to do with the news behind it. I don't. Etsy is below the 200-day moving average and moving sideways, so not something we would want to own. BAC is a name that we were looking at potentially owning, but instead of BAC, let me ask you a question. This has nothing, well, it does kind of have something to do with it. Look at look at Bank of America. Look at where it's at in a chart. It's above the 200-day moving average, which is great. Sloping up, consolidated here, going back to December, so about a two months of sideways action in BAC. Would you rather own this, or would you rather own this? Right? Right? Hopefully this is instilling something in you. Own the names that are outperforming everything else. Don't own the shit that's lagging. It's lagging because it sucks. Just because something is down doesn't mean that it's going to go up more. Buy the strength in bull markets and see how high these things can go. JP Morgan, since the November low, is up 33%. Bank of America, off of the November low, is up 33% as well, except JP Morgan is at all-time highs that doesn't have to fight through overhead supply. Bank of America does. So there's going to be inherent resistance that you're going to have to fight through. Everybody that bought Bank of America here and here, who knows? Maybe they're going, I want out. I'm just happy to be at break even. You know how this shit goes. That's real. JP Morgan has nobody up here anymore. There's no more resistance. We're in something called Big Blue Skies price discovery mode. So if there was, you have a group of stocks you're looking at within a specific sector, JP Morgan is an obvious one because it's an all-time highs. But let's go back a few months. Like airlines are a good one to run this through. I've never done this, but airlines suck. From a swing trading perspective, this is trash. Unless you nailed the bottom, congratulations. But this is a promising group that is starting to look like maybe there's something here above the 22 level. And in this case, we're going to go hunt Delta. We're going to go hunt American Airlines. We're going to go hunt United. Some of the smaller LATAM airlines like Azul, JetBlue, which is hilarious right now, Save, Spirit. Go and build a watch list of all the different airplane names, aero manufacturer names and everything else, and then go and buy the one that's already outperforming, and it's probably going to outperform all of them. There's a reason why these things outperform. I'll give you another good example. We're in this trade, KKR. Here's an investment manager group at all-time highs. So once again, you could have gone and bought, I don't know, I think Wells Fargo actually had a good day today. Wells Fargo, which we had guys inside of TTI take, or you could have owned Citigroup, or you could have owned KKR, right? So if there's anything you take away from this little piece of conversation is don't be afraid to buy the names that are outperforming everything. You'd surprise yourself with how much better they do over time. All right, I don't want this to go longer than an hour, so a couple more minutes. Yeah, this is fantastic. This would be something that you potentially want to own. It's been incredibly hard for us. We've had this on our radar. It's on the 50-day highs list every single fucking day. We actually did have a position in this at one point, but we weren't able to hold it, and we did buy the potential state. I think Dom, I don't know if you're in here, Dom, or not, but it was something like this. Dom did buy it. We were unable to hold because it was hard. Like, this is not an easy trade. In hindsight, you could look at this and go, oh, I made a lot of money, but could you really hold through that? That's fucking hard. So unfortunately, this is one of those names that we never really got a foothold on that looks fantastic. So in this case, like, you're absolutely right. This would be something where you'd want to buy in on some sort of consolidation, continuation, or a pullback to some sort of dynamic support. This is a fantastic looking stock. The benefits, by the way, of owning something pulling back into dynamic support as an options trader is that you get things like 50% off, right? Contracts are going to move way faster and deeper than the underlying asset. So let's say, for example, SFM comes down to 50 or 49 and just randomly throwing it out there, pulls into some sort of dynamic support you like. The contracts that these guys bought for a continuation play, they're probably going to sell to you for like 50%, if not a little bit more off. It's the same trade idea you're considering or assuming that there's going to be a continuation play in the books. They think they bought the top, and you're able to buy those off of them with a stop right below your dynamic support. So it's an awesome way to get into strong names at cheap discounts, right? Steep discounts, rather. ABBV. Yep. So we're looking to get long healthcare right now as well. And this is an all-time high, right, for AbiVi? I could draw that a little better, I think. But yeah, why would you not? This is fantastic. Good job, whoever called this out. This is something that we would 100%. So I'll actually build this out now because I like it. So I appreciate you for telling me that, because we are trying to get long. Does it have to be any harder than this? Probably not. That is a potential all-time high horizontal level breakout above 175, 176. Target the 200 to 205 spot. Here's your long tool. Doesn't have to be perfect. Get a general idea of risk to reward here. Let's pull this over so get a better view. Where would we want our stop based off of technical analysis? This is another topic of conversation, but where is the trade idea invalidated? Below the swing low. All right, so there's your 6 to 1 setup. There's your trade idea. Thank you for giving it to me. But now you got to go check the options chain and make sure it makes sense. But there's a 6 to 1 setup on AbiVi, so good job. How do you find stocks to have strength? Different topic, but that's great. I do have Koifin. You do not need to buy it. I'll give you, I think that's the last one. Last one I want to talk through, but I'm going to show you. I'll give you a little sales pitch on Koifin really quick. I don't get paid to say this, but Koifin is fantastic. Number one used tool by me, and I try to push it on everybody in TTI. Using things like U.S. sector strength and industry strength is where we can figure out where we want to be operating in the market. So, for example, you're looking at this chart right here. What's the leading sector? Communications. We know why. Meta, Netflix, Disney starting to help. Some of the old school telecom names like T-Mobile are at all-time highs or near there. Healthcare, we were just talking about. We want to get it. So shout out to AbiVi. Healthcare, number 2. Tech, number 3. So that's how we figure out, depending on which time frame you're looking at, which sectors we want to focus on. This is part of the free version of Koifin, and it used to be at least. Go to industry groups. You can see, obviously, semiconductors are outperforming. Go back 1 year, by the way. It should still be semis by a lot. It is. So once again, market leaders tend to lead for an extended period of time, which is why we put so much emphasis on this stuff. Internet names, insurance names, software names, starting to get oil names popping up, which is going to fucking blow to trade if energy starts to run. There's your Jets, year-to-date, outperforming the S&P 500. So you know what's outperforming. So you can start to whittle down that. There's usually 9,500 things you can trade in a day. When you know which type of sector and industry group that you want to be focused on, you can take that down from 9,500 to like 300. And then from there, the paid part that I really like are ETF deep dives. So I don't know, let's use Jets because we were talking about Jets really quick. You can type in Jets, pull it up, snapshots, holdings, year-to-date performance. TAVHL is up 50%. ULCC Frontier is up 41%. Pegasus, JetBlue, TripAdvisor, Southwest, all of these. And you start ranking them, right? Obviously, you have the scatter plot as well. But now you know which stocks are outperforming within Jets. So I'll ask you a very simple question. If there's a setup in the top 10 that's giving you an opportunity to enter, whether it's a horizontal level or if it's already broken out, like we talked about, continuation patterns, etc., would you rather own that or would you rather own the names that are down 23%? I'm going to tell you something. In bull markets, you want to be buying fucking strength. So focus on the names that are outperforming. Don't buy the dumpster shit. It's dumpster for a reason. Okay, so this is my pitch for Koifin. I don't get paid anything there to tell you that. But it's a fantastic tool. If you don't want to lose money, you need to learn how to read price, how the algo books liquidity. The last thing I'm going to say is anybody that tells you algorithms are the enemy is a low IQ individual. I don't trade on the 1 second time frame for a reason because I'm not a fucking moron. Of course, the markets are manipulated. They've been manipulated for over 100 years. Charles Dow told us that actually over 100 years ago. The guy that literally invented the industrial averages and the transportation averages that we've used for 100 years said that, yes, the markets are rife with manipulation on the shorter time frames. So if you, Mr. You're 9314, want to operate on a time frame where you're fighting against high-frequency trading firms and dudes that fucking don't sleep and rail Adderall and have PhDs and shit, feel free. That's completely up to you. You want to make 25 cents per day doing shit like that? I'd prefer to buy things with 6-month outlook on strong